Good morning, everyone. If you can please get seated so that we start. Perfect. Thank you very much. Good morning again. I'm Panos Katsambas. I'm a partner in the funds and private equity group at Reed Smith in the London office. And it is my pleasure to moderate this panel once again. Just by looking at some of the panelists here, I think it is fair to say that private equity in shipping has been a long-standing participant and still very much interested in opportunities in the space, and we'll hear more about that later on. But some of the panelists on my right have been consistent participants in this conference, so I think that speaks on its own merit. I think today, when looking back over the last 10 years, private equity takes a much broader part in the space from the traditional equity investment in a shipping company, and we see funds having replaced financial institutions in providing financing, assisting shipping companies structuring their debt, acquiring debt from financial institutions looking to exit the market, and make new equity investments, whether by way of new money or by way of exiting existing private opportunities in exchange for shares in publicly listed companies. We'll touch upon the trends in the market and what type of transactions are of interest, but before we get into the more nitty-gritty, I'd like to ask my panelists to briefly introduce themselves.
Kevin O'Hara from AMA Capital Partners in New York.
Andy Dacy from Jpmorgan Asset Management.
Paulo Almeida from Tufton, Oceanic.
Perfect. And I'd like to start, Paulo, actually with every one of you, and just a brief commentary about the current trends you see and what type of transactions are of particular interest, if at all, at this current timing. Yeah.
You may have heard Axel from the London Stock Exchange, who was one of the first speakers this morning. He mentioned that Tufton, we launched a listed fund about 18 months ago. As he said, it's about 225 million of market cap, and it's been trading at a premium to NAV, and we had about a 10% unlevered return last year, which our investors are quite happy with. In addition to the listed fund, which has a mixed portfolio of bulk product tankers, one gas tanker, some container ships, and some MPPs. We have 3 private funds that we invested in between 2013 and 2017 or so, which have about $1 billion of ships, all unlevered. So all of those ships that I just talked about are unlevered, which is a key part of our strategy, and those as well are mixed fleets. So we're seeing opportunities across the sectors. We tend to fix in 2 to 5 year charters on our vessels. We tend not to have leverage. We are targeting and have produced pretty steady, moderate returns. We're trying to produce returns that are about twice that of unlevered real estate, which is what our investors are looking for without much more risk than real estate.
So in terms of Jpmorgan, we've been investing in the space for the last 10 years. We have primarily focused on acquiring vessels. For a time, we had some relationships with existing shipping companies where we did joint ventures. I would say that in the last 7 years, we've pursued a more 100% owned strategy. I think that private equity, generally speaking, probably is seen, or what I've seen at least, is them private equity moving more towards the debt side, and that seems to be the trend over the last couple of years. At least that's been more the majority of the PE activity that we've seen. We don't do debt. That's not to mean that debt isn't attractive. I just think it's 2 different types of investment strategies. From a transaction perspective, like Paulo, we believe that there are opportunities in the asset owning space, and we see them. I think certainly decisions have to be taken as to how long you're going to time charter your vessels. Are you going to pursue a spot strategy? Certainly opportunities in both. I think, if anything, the shipping industry right now is going through a bit of a transition with regard to, as Panos mentioned, not a lot of banks are lending. Let's say private equity has stepped into that breach. The cost of that capital is certainly a lot higher. And I think one of the things that I've often said is, as an industry, we have to think more about what the sort of reasonable levels of returns are for this business. And from my perspective, high single digits is what I think is reasonable, with modest leverage, in some cases no leverage. So high 15, double digit, 20% type returns, I think is achievable, but it's the black swan rather than the white geese floating around in Green Park. So anyway.
Kevin, a bit of a perspective from the investment banking side.
Sure. For AMA, we've seen the industry, the private equity side, much more from the restructuring standpoint over the last few years, both as initial investors who end up in restructurings or investors in distressed debt, going through the restructuring process, having bought out banks that had sold at a discount. I think what we've really seen over the last couple of years is a little bit to what Andy was speaking towards, much less a classic long play and more towards structured deals, more towards secured lending, where you'll put back leverage on it. So I think people have been a bit burned from some of the long plays where they expected the market to recover and it never did, and now we're looking at deals where they can get a high single-digit return with a little bit more of a charter coverage, strong asset coverage on those loans, and put the back leverage on it to get to where they need to be in terms of a mid to high teens on a total return basis.
Looking at the title of our panel here, it says whether private equity is an opportunistic short-term or a strategic long-term investor in shipping. I think we've answered that, and it's obvious that the industry is here as a long-term investor. But at the same time, the question is, does PE drive industry consolidation? And while in other sectors where private equity is investing, we've seen a lot more examples of consolidation as part of the traditional investing play. With the exception of some transactions that one can say fall within this sort of consolidation theme, private equity hasn't been able to spearhead a consolidation in the shipping industry. What do you guys think is the biggest obstacle in achieving that? And should that be something that private equity investors should strive or attempt to do? Andy?
Yeah, I don't know if consolidation necessarily is a stated goal that should be pursued. What I think is happening is there's a natural consolidation happening only because the amount of capital in the industry is reduced, and so we've seen a bifurcation between the higher priced debt that's available from some private equity shops, which perhaps tends to move towards older vessels or situations where the company, for whatever reason, can't access traditional bank financing. The traditional banks have now moved much more towards a corporate-style financing where they want corporate guarantees, they want big balance sheets, they typically will follow much more low leverage. They're sensitive to some of the technological changes that are happening in the industry. They're looking for longer-term coverage or an embedded team that has a proven track record of trading. And I think that this capital, whether it's PE or banks in general, the reduction of capital in the industry is, by definition, going to spur a consolidation. So maybe the PE shops haven't achieved that, but I do think the industry is moving in that direction. And if you look at the environment that we're in, it's historically been the case where you've seen a lot of high leveraged capital available that's allowed markets to create an asset play environment where people come in and out and borrow lots of money and it pushes asset values up. I don't see that today, so I don't think there's necessarily so many opportunities to buy distressed assets and expect for the market to improve and sell them at a high value. I think you have to look at an asset as a depreciating asset and take a very sober and conservative view as to where that asset's going to be in 5 or 10 or 15 years' time. I think the industry is now becoming much more of an earnings market as opposed to an asset play market, and I think that in of itself will spur consolidation.
Paulo, your thoughts?
Yeah, I guess thoughts on consolidation. I guess in general, there's probably 3 reasons to pursue M&A in any industry. Like Andy, I stopped being an investment banker 10 or 12 years ago, but we can play investment banker for a little while and then let Kevin chip in. So if we look at some aspects, synergies is one. I think synergies are pretty close to zero in shipping if you have two well-run dry bulk companies that have 30 or 40 ships each. Are you going to get much synergies either in revenues or costs from putting them together and having 80 ships? Very unlikely that that's material. Cost of capital, Andy's already addressed. Banks are much moving towards just lending to corporates and listed companies as opposed to private companies, so bigger is better in that way. I think the driver, though, of the consolidation that we've seen driven by private equity is liquidity of shares. The bigger the market cap, all else equal, the more liquidity there should be, and these are private equity investors that are very different from what Jpmorgan or Tufton do, in that they do have 3 to 5 year horizons, whereas we tend to have more like 10-year horizons and are long-term committed to shipping. They need to get out at some stage. If they need to get out at some stage, they need to have a larger listed company where there is some liquidity so that they can exit those investments in a reasonably orderly fashion. Kevin?
Yeah, for commodity shipping, I think the consolidation idea has been a bit of a white whale for the last 200 or 300 years. We'll see if it continues. But it's very hard to consolidate an industry where someone can, like 4 people up on this panel, can go out and raise money and order new ships. But it does get back to the capital discipline that's been referenced here a few times, whereas the bank debt is not as available. That idea of somebody just starting up something new and building 20 ships is less likely these days. From my perspective, the opportunity for consolidation really comes down to building companies that can sustain themselves through the cycles, have better availability, better access to the capital markets, rather than the idea of having a kind of market power in dry bulk, for instance, because that, to me, would never really happen. So having that balance sheet where you can get the best financing out there, get the money you need when you need to replace your tonnage or when you want to do an acquisition, use your shares as currency, those are the types of things that would, in my mind, lead to a real reason for consolidation.
And you mentioned at the end using your shares as currency. In the last couple of years, we've seen a few of the listed companies trying to do that and acquire fleets by offering shares as consideration. Is that something that we should be seeing more? Is that something that the listed companies should be evaluating in more detail, try to grow through transactions like that?
Yeah, I think so. Easier said than done when your shares are trading at a discount to NAV, but I think what you've seen, at least in some sectors, those discounts have shrunk over the last few months. And I think once you start seeing somebody trading near or above NAV, it becomes a lot easier to do that. But that kind of consolidation play, when you have multiple dry bulk or product tanker or tanker companies that really look the same in the end of the day, to put them together in a bigger vehicle through those share transactions, I think makes a lot of sense.
Let me just add to that. I think the challenge, I think merging 2 public companies makes a lot of sense if you can find a relative pricing mechanism that gives both sides comfort. But when you're faced with potentially taking privately owned vessels and contributing them into a public company and taking shares in exchange, then I think given the malaise that we see in the publicly traded environment for shipping, you're faced as the owner of those assets with a very difficult exit proposition. And how long will it take you to get out? Will you get out at a good price? And are you sacrificing any earnings that you're achieving? If that public company is not a dividend payer, then you're essentially abandoning your asset and having to dig your way out of that public company over time. So that's been one of the issues that I've seen out there in terms of private ships going into public entities.
So effectively, kind of when you were doing some of the initial joint ventures between shipping groups and private equity, as you looked ahead 5 years perhaps, a listing was one of the potential exit opportunities. Do I take it with your comment that sort of today, in today's environment, as a private equity investor, exiting through the public markets is not really much of an option.
I mean, just to respond to that, as Paulo mentioned, at Jpmorgan, we take a much more longer-term approach. So our view is, if we own the assets for their entire useful life, that's fine, and we underwrite on that basis. And we don't have any mandated exit targets. So, but for some PE firms and closed-ended funds, they do have to get out. So that becomes a bit more of a challenge.
Paulo, your thoughts on that? And
Yeah, we've had some involvement in public companies or potential public exit strategies over the years. I think that if a deal is well structured and it's ready for the markets and the markets are ready for it at the same time, which has not really come together very many times in the past 10 years, then yes, public exits are feasible. Are they something that you should include in your analysis when you look at an expectation of return? Absolutely not. The past 10 years or 9 years show that it's very, very difficult to have a shipping IPO. Very, very few have happened, especially ones where there is a significant element of initial sponsors exiting as opposed to just new money being raised. But it's public knowledge we were involved in Hafnia together with our friends at Blackstone through a large number of transactions over a few years. We've now turned that into a much smaller stake in the new Hafnia, which has the Sowen Powell family via BW as its largest shareholder. That went reasonably well, but it was a lot of hard work over the years, and the return, I think, I would say was only decent as opposed to fantastic. Certainly not 15%, but we're reasonably happy with it.
let me switch gears a bit, and Kevin, we've witnessed also in the last few years, again, not the traditional asset play, but a lot of the funds investing, either acquiring non-performing loan portfolios and then participating in restructurings of the shipping companies, or more directly buying debt and forcing restructurings. And we've witnessed a lot of the listed and private companies affect broad range debt restructurings. What is, the lessons we've learned and where the situation is today in terms of opportunities from the more distressed restructuring type approach in the space?
For the funds that are acquiring the non-performing loans, there's an interesting aspect there, other than the obvious liquidity it's provided to the banks, because for some of these portfolios, I don't know where else you would be able to sell those if private equity hadn't stepped up to the plate. But also these portfolios were a bit, in my mind, full of stranded shipping companies. There may have been some investments that were debt investments, that were KG investments that were so far underwater they never were going to come back. But there were also performing shipping companies in there where you had the bank that's exiting the industry. That was probably a relationship for a long time. They no longer had somebody to go to finance or to grow with. So now you have a private equity player has seen the portfolio from the inside, has seen the bad parts, but also sees the good parts, where they can say, okay, this one here is actually performing, and well, let's stick with them and put some more money with them longer term.
And you guys, have there been any opportunities from that sort of debt restructuring space in terms of enabling you to buy assets that otherwise would normally come in the market?
As I said earlier, Panos, we don't do the debt side, and I don't think it's necessarily a bad place to be or a good place to be. It's just it's a particular skill set. So I think there's been plenty of opportunities to restructure and get to the assets, and I think people have done okay.
No, and more from the opportunity to acquire the asset directly as opposed to the debt. Like have those transactions spurred more assets, more asset opportunities?
I mean, my 2 cents on that is that I think if you have a bilateral loan, if you step into that and you become the replacement entity for the bank that you've bought the loan from, and there's not a syndicate in place, then those are probably the best opportunities to go and actually acquire the asset, but you have to go through a fairly lengthy legal process and arrest the asset and go to auction and all of that. If you get into a syndicate, and that's always been where we've had a concern, is you may have different views from the syndicate members, and you might buy one syndicate member's position, but the other syndicate members may have still be banks that look to long-term relationships and may not want to act as aggressively as perhaps the private equity side would. So these are just some of the concerns that we've seen, at least in trying to execute asset acquisitions through debt.
So like Andy at Tufton, we don't buy loans. We have looked at buying sub-performing loans recently, but we have not been active in it. What we have done, however, is we've acquired quite a lot of assets from banks as asset transactions. So we don't buy the loan, but we buy the asset. At least half of the ships that we've acquired over the past 2 or 3 years were either sold by a bank directly or with a bank somehow in the background, for example, with KGs actually doing the selling. The other opportunity that arises more recently than that, so that's the past 3 or 4 years, is a lot of the U.S. Credit investors who have bought large portfolios from some of these banks, who now are doing the same calculus, but probably act a little bit more quickly and proactively in executing on that calculus of what in this portfolio of loans do I want to keep for a few years, what do I want to convert to equity because I think there's upside in these assets, and what do I just want to sell quite quickly, whether as a loan or as an asset, just to de-risk the portfolio a bit and maximize the IRR. So there have been, it's not an area where we have transacted yet, but we have looked at quite a few opportunities from these U.S. credit investors who own primarily German loan portfolios, who then look to transact the same way that banks have in the past.
Excellent. And one last question around the topic of restructuring is, what do we expect in the next couple of years in the space, Kevin? Are there more companies that will need to find ways to restructure the debt?
I certainly think there is. It's kind of a classic issue for the shipping industry in general. I think offshore is in much worse shape. We just haven't seen the assets, the amount of assets reduce at all. We've had some good examples of fleets of offshore assets be sold, some of them 20 years or more, and when the vessels go up for sale, none of them go for scrap. And then you look at the overall picture, whether it's rigs or supply vessels or more sophisticated offshore vessels, you just don't see the level of scrapping that you do on the shipping side. So I think first and foremost, you're going to see offshore struggle for the next couple of years because of that. But then you're also going to always have subsectors within shipping that go through their own issues as well.
Let me switch gears a bit and touch upon kind of indirect concerns, let's say, that may be affecting or not your views and investment opportunities. We've witnessed a lot in the last, in the very near recent future, political tensions, trade wars, and at a certain extent, some of those matters escalating to situations with governments pushing other governments to arrest vessels, potentially impacting the routes that vessels sail through and all that. Likewise, we have a big push with the IMO regulation on environmental compliance and all that. And from the standpoint of private equity investors, how much do these parameters, environmental issues, risk from potential exposure by owning these assets directly, or being caught into a situation on whether it's sanctions or political tension? How much do these parameters affect your investment process and decision making? Paulo, you want to?
I think it's fair to say that most of our investors tend to have a front office and a middle or back office, and the things around sanctions, basic compliance, insurance, war risk, these sorts of things, those tend to be more sort of middle office issues. So the operational people, the risk people, are the ones that are concerned about that. And luckily with them, we get more airtime. So when they come for a meeting, it's a 2 or 3 hour meeting as opposed to a 45-minute meeting, so we can go through all of those issues. Environmental, however, over the past couple of years has become a very, very significant front office issue. I was at the ABS seminar where Andy was speaking yesterday together with Chris Vernicki from ABS and another owner and another charterer about this, so it won't come to as a surprise to many in here, but environmental issues are very, very significant to the sort of investors that we have, which are often European pension funds or people who manage money for smaller European pension funds. So as Jpmorgan is affiliated with the Poseidon Principles, what we did at Tufton last year is we became a signatory to the United Nations Principles for Responsible Investment, which is one of the major ESG frameworks for institutional investors. And of course, we're focusing on the environmental aspects of that. We're doing things like limiting the amount of chartering that we do with companies that trade a lot of coal. So we will favor agricultural companies as charterers over companies that carry a lot of coal. We're doing a lot of work on increasing fuel efficiency of the current fleet. So we spend some money on dry dockings, on propeller modifications, better paint, et cetera. And the best thing about all this is that it's actually very accretive to an investment. So environmental used to be about risk mitigation. There was a talk earlier today about stranded assets. You don't want to buy a ship that is obsolete when it's 15 years old because it produces a lot of emissions, et cetera. That's been a key aspect of what we do for many years. We never bought ships with high fuel consumption because of that impairment risk. But charterers today are now much more willing to pay more on a daily rate for a ship that has less consumption than a benchmark vessel. So if we can make a couple of $100,000 of spend in a dry dock that saves 2 tons or 3 tons of fuel a day, and we get $500 to $1,000 per day per ship, that's a pretty short payback period. So it's actually the best of both worlds. It's reducing emissions, and it's also accretive to our investment.
Andy, your thoughts?
Yeah, I might just sort of further underscore what Paulo was saying about the ESG side of things. And those of you who've heard me speak before, I've sort of been on this bandwagon now for the last couple of years, or last year, let's say. But everything that Paulo was saying is alive and well in the global investor universe. So institutional investors, whether they be insurance companies, sovereign wealth funds, pension funds, more so in Europe, but certainly catching up in the U.S. And I think probably Asia is in third place, but I think they'll come around as well. There's no investor out there that's not making a decision without thinking about the ESG status of the companies that they're investing in. And you see this happening across the board in a very broad way beyond shipping. Morgan Stanley Composite Index now has an ESG coefficient for the companies that make up that index. So if you're not thinking about this, then I think it becomes a lot more difficult to articulate what your strategy is to investors that are thinking about it. And it can certainly include some of the things Paulo mentioned, and I think there's a lot of good things that are happening in shipping, but there's also things that are less ESG favorable. And it's not just environment, it's the social side of things. It's working with your crew and your constituents to make sure that you're working with them in a very transparent and open way. And so really bringing shipping out of the darkness where maybe it's been less so, but if you go back 30, 40 years, it was not very transparent, and it just needs to be more so. And the other thing that I think is connected to this is the next step of technological change. We saw eco engines having an impact during the last 10 years. I think the big question now that everybody is struggling with is what's the next propulsion system, and that's the E part of the ESG, and are we going to find ourselves sticking with LNG? Are we going to go to hydrogen? Are we going to go to ammonia? Are we going to go to something different? Are we going to be able to find a way to produce synthetic fuels? What are the implications for that in terms of the value of vessels you buy today? You buy a ship for 25 years. If all of a sudden there's a technological change that accelerates the obsolescence of the existing ships, then you have to start radically rethinking how you underwrite the useful life of assets. And it's not necessarily something that's very clear because each one of these propulsion opportunities has issues, right? Ammonia, if you inhale it, will kill you. Hydrogen needs a lot of containment. So there's lots of questions out there, and these are things that we think about.
And obviously for the ship owners audience here, I mean, take notice of the things that the investors and how they approach issues and the issues they have to deal with their investors in terms of the underlying investments and the compliance with applicable regulations and so forth. I see a lot of zeros in front of me on the time remaining. Kevin, any final remarks?
Paulo alluded to the coal, which a very small, quick anecdote, which I find instructive. The AMA had an investment in rail cars, and a very small part of that portfolio were coal cars. And literally overnight, we went from having them on lease to a major utility in the U.S. to them handing them back saying, no thanks, we're done with coal. It's a bit extreme. I don't think it'll happen that quickly on a global scale, but it'll certainly be, that dynamic is coming into play.
Do we have any time for any questions? No. Okay, well, that's it. Thank you very much, gentlemen. Thank you.